Nigeria's 2025 to 2026 tax reforms. 1. Introduction and legal foundation. Nigeria's tax system underwent a fundamental overhaul with the signing into law of 4 major tax reform acts on 26 June 2025, which take full effect from the 1st of January 2026. These reforms represent the most comprehensive restructuring of Nigeria's fiscal and tax architecture in decades. The 4 principal tax statutes: Nigeria Tax Act (NTA) 2025, Nigeria Tax Administration Act (NTAA) 2025, Nigeria Revenue Service Establishment Act 2025, Joint Revenue Board Establishment Act 2025. Purpose of the reforms: harmonize previously fragmented tax laws, modernize tax administration, expand the tax base, especially digital and cross-border activities, improve compliance and enforcement, reduce tax burden on low-income earners and small businesses, align Nigeria with OECD and global tax standards. 2. Institutional and governance structure. Nigeria Revenue Service (NRS). Definition: the NRS is the Central Federal Tax Authority, responsible for administering all federally collectible taxes and selected non-tax revenues. Key features: replaces the former Federal Inland Revenue Service, affairs governed by an autonomous board, chaired by an executive chairman, funded by a 4% cost of collection allocation, excluding petroleum royalties, empowered to recover unremitted revenues directly from MDAs. Joint Revenue Board (JRB). Definition: the JRB is the apex coordinating body for tax administration across federal, state, and local governments. Functions: harmonizes tax policies and practices, resolves jurisdictional overlaps and multiple taxation, advises on double taxation, maintains national taxpayer databases, publishes tax expenditure reports, conducts compliance audits and policy research. Oversight: National Economic Council Tax Appeal Tribunal (TIT), specialized tribunal with zonal divisions, exclusive jurisdiction over tax disputes. Appeals lie on points of law to higher courts. Office of the Tax Ombud (OTO). Definition: an independent, free, and impartial body established to protect taxpayer rights. Functions: investigates administrative misconduct, mediates disputes between taxpayers and tax authorities, recommends corrective actions, cannot determine tax liability or interpret substantive tax law. 3. Scope of taxation and tax nexus. Expanded tax nexus. Nigeria moves beyond traditional permanent establishment (PE) rules to include economic participation. Key concepts: permanent establishment (PE) expanded to include a place of management in Nigeria. Significant economic presence (SEP) applies especially to digital and online businesses. Multinational enterprises (MNEs). Definition: any company operating in more than one jurisdiction, including Nigerian companies with foreign operations. Taxable Nigerian source income includes services provided to Nigerian residents, even without physical presence. Insurance premiums derived from Nigeria. Direct supply of goods through PE. Capital gains from disposal of shares, where over 50% of value is derived from Nigerian assets, or ownership of Nigerian companies or assets changes. Gains from disposal of businesses or assets located in Nigeria. 4. Anti-avoidance and global tax alignment. Minimum effective tax rate, 15% minimum ETR, applies to multinational groups with 750 million euros plus global turnover. Nigerian companies with 50 billion naira plus annual turnover. Top-up tax applies where effective tax paid is below 15%. Free zone companies exempt only on export income if not part of an MNE, controlled foreign company, CFC, rules. Nigerian tax authorities may attribute profits of low-taxed foreign subsidiaries. Aims to prevent profit shifting and base erosion. Minimum profit margin rule. Nigerian PE or SEP must be taxed at not less than the parent company's margin PE, deemed to have the same credit rating as parent. Only expenses directly linked to taxable profits are deductible related party payments, royalties, and management fees are generally disallowed. 5. Corporate taxation. Company classification category. Small companies. Turnover less than or equal to 50 million. Naira to 100 million Naira. Context-based. Tax treatment. 0% CIT, CGT, and development levy category. Others turnover above threshold. Tax treatment. 30% CIT plus 4% development levy. Note: medium-sized company category is abolished. Development levy. 4% of assessable profits consolidate. Tertiary education tax. Eti levy, Naseni levy. Police trust fund levy. 6. Capital gains tax. CGT. Key reform: CGT rate for companies increased from 10% to 30%. Align CGT with CIT to eliminate tax arbitrage. Indirect share transfers, offshore disposals of holding companies now taxable in Nigeria. Exemption: share disposals less than or equal to 150 million Naira within 12 months. Gains less than or equal to 10 million Naira. Digital and virtual asset CGT now applies to cryptocurrencies, tokens, digital property. 7. Personal income tax, PIT. Progressive PIT structure, 800,000 Naira or less annually, fully exempt. Top marginal rate increased to 25%. Residency rules. Resident individual based on physical presence. Permanent home, economic or family ties. Taxed on worldwide income. Non-resident individual taxed only if duties are performed in Nigeria and income is not taxed elsewhere. Compensation relief. Exemption for loss of employment or injury increased from 10 million Naira to 50 million Naira. 8. Value added tax, VAT, and indirect taxes. VAT rate remains 7.5%. Major VAT reforms. Input, VAT recoverable on goods, services, capital assets. Applies to non-resident digital suppliers. Zero-rated items. Expanded basic food, medical, and pharmaceutical products. Educational materials. Electricity tuition fees. Non-oil exports. Electric vehicles. VAT fiscalization and e-invoicing. Mandatory real-time. Electronic invoicing. Nigeria becomes an early African adopter of VAT fiscalization. Stamp duties. Flat 1,000 Naira on agreements and contracts. Exemption. Contracts below 1 million. Naira employment contracts. Sale of goods contracts. Gaming and lottery tax. Broad taxation of gambling, wagering, betting, and games of chance. 9. Investment incentives and free zones. Economic Development Incentive, ADI. Replaces Pioneer Studies 5% annual tax credit for 5 years on qualifying capital expenditure. Unused credits may be carried forward. Limited period. Free zone/EPZ treatment. Export income remains exempt to stricter compliance for domestic sales. No capital allowance for assets that evade VAT or import duty. 10. Tax administration and compliance. Taxpayer identification number, TIN. Mandatory for all taxable persons. Required for banking, procurement, digital transactions. Self-assessment system, PIT and CIT. Annual returns VAT. Monthly returns. Special returns for oil and gas. Mining, aviation, shipping, virtual assets. Payment rule. Taxes not under dispute must be paid within 30 days of assessment. 11. Penalties and enforcement. General penalties. Late or inaccurate filing. Escalating fines. Unpaid tax. 10% penalty. Interest at CBN, MPR Naira or SOFA foreign currency. Serious offenses. Failure to deduct or remit tax. False declarations. Fraudulent refunds. Impersonation of tax officials. 1 million to 10 million Naira fines. Imprisonment or both. Sector-specific sanctions. Virtual asset service providers. Heavy fines. License revocation oil and gas companies. Daily penalties. Asset distraint. License cancellation. Personal liability directors and officers may be held personally liable unless lack of knowledge is proven. 12. Dispute resolution framework. Advanced rulings provide certainty before transactions. Binding only on applicants and transactions. Objection. Must be filed within 30 days. No response within 90 days. Objection upheld. Appeals. Tax Appeal Tribunal, Federal High Court, Court of Appeal, Supreme Court. Amicable settlement allowed in public interest. Prohibited in cases of fraud or intentional evasion. 13. Overall exam conclusion. Nigeria's 2025 to 2026 tax reforms establish a modern, digital, enforcement-ready and globally aligned tax system. The regime broadens taxing rights, strengthens compliance, enhances taxpayer protections, and repositions taxation as a tool for sustainable economic growth. Success will depend on effective implementation, institutional capacity, and taxpayer awareness